everybody, and welcome to the second half of the Phillips curve. This video, we will use the model we previously employed. We will talk about moving along the short-run Phillips curve, and we'll talk about shifting the Phillips curve when we have changes in expected inflation. Between the 1961 and 1968, the economy moved along the Phillips curve. We had a positive shifts in the aggregate demand curve. Unemployment fell. The inflation rate grew moderately. However, something happened in the early 1970s. From 69 to 71, we almost had this horizontal shift back up. This would align with the Milton Friedman and Edmund Phelps idea that expectations met reality. Everyone started to expect 4% inflation, and so the natural rate of unemployment prevailed. Between 1972 and 1973, we're shifting up again. Higher inflation, lower unemployment. In 1973, we had the first of two oil shocks in that decade. 1973, OPEC restricted production, increased the price of oil dramatically. 1979, we had the Iranian Revolution, which dramatically decreased the supply of oil, also putting upward pressure on the price of oil. This affected our economy via the supply curve. So the short-run aggregate supply curve is going to shift because now firms are less profitable than they used to be. This will shift the aggregate supply curve, and it shifts the Phillips curve. First on the left, we have our aggregate demand and aggregate supply curve. The oil shock will cause a leftward shift. These firms are less profitable, so they're not as willing to supply their stuff to the market. This causes the GDP to fall, and it causes inflation to rise. If we look over in the Phillips curve graph, where an inflation and unemployment rate are on our axes, this means we have higher inflation and a higher unemployment rate, a rightward shift in the Phillips curve. Again, notice point A's line up with the point B's between these. The price of a barrel of oil in 73 was $3.56. I mean, that's inflation for, today, it's hovering around like 50, 60 bucks or something. And in 2007, it was well over 100. It's like $120. And back in the 73, $3.56. Back in my day, 1974, whoa, it practically tripled in a year. That is going to have a huge effect, big negative supply shock. The Fed, during this period, they chose to accommodate the first shock in 1973 with faster money growth. They wanted to fight off this inflation, so faster money growth. Okay, so we don't cause a recession. We saw a recession was coming, we want to fight that, so we have expansionary monetary policy. The result was higher expected inflation, which further shifted the Phillips curve in the long run. People adjusted their expectation inflations. They saw the inflations in 73, 74. They're like, oh, here's the new normal. We're going to expect it now. And so the Phillips curve is going to shift. The expected inflation is also higher. Well, along comes 1979 and the Iranian Revolution, and the price of oil again surged for these 3 years. $14, $32, $38. It more than doubled over those 2 years. And now it's going to be more difficult. The Fed can't just keep increasing the money supply to fight off the recession. Inflation is beginning to become a serious problem. Let's see what the data did. 1972, 73, 74, 75. That rightward shift between 73 and 74, 75, that was caused by the supply shock, which moved the Phillips curve up. When we went between 75 and 76, things were getting better. And then the supply shock was starting to wear off. From 76 to 79, that's just moving along the Phillips curve. The Phillips curve had shifted up there. We had a growing economy. Prices were not changing too much. Relatively high. The inflation rate is 6 going up to 8%. However, 79 comes along. We have again a huge negative supply shock from the Iranian Revolution, moving us from 79 to 81. That upper right movement along there is caused by that negative supply shock. Inflation rate is 10%. The unemployment rate is 7-8%. We're in stagflation. High inflation, high unemployment. The Fed is not going to be able to just fight the unemployment, because if they do that again, just like they did in 73, it will cause even more inflation. The Fed decided to fix inflation. They could fix one or they could fix the other. The Fed's primary mandate is stable prices. It is only a secondary mandate to maintain stable employment levels. Disinflation, this is not the same as deflation. Deflation is negative inflation. Disinflation is a lower inflation rate. So moving from 10% to 8% would be disinflation, even though 8% is still highly inflationary. To reduce the inflation, the Federal Reserve must slow the rate of money growth, which will reduce aggregate demand. They're going to cause a recession. In the short run, output falls, and the unemployment rate rises. We don't like that. However, in the long run, the output and unemployment will return to their natural rates, and all will be well. We will have more stable prices in the long run. To model this, here we've got a situation. We've got some high inflation. There's our long-run Phillips curve. There's our short-run Phillips curve in the blue. Disinflation, reducing that inflation rate in the short run, is going to move along the Phillips curve to the right, causing high unemployment in order to decrease the inflation rate. Over time, everyone's going to get used to smaller inflation levels. They're not going to be thinking the inflation is 10% all the time. They're going to think, okay, this is cool now. Inflation is now 4%. Oh, cool, the inflation is now 2%. And that will shift the Phillips curve downward as everybody's expected inflation diminishes. In the long run, at point C, the natural rate of unemployment prevails. And in the long run here, we're going to have lower inflation. However, this comes at a cost. We had higher unemployment because of this. That's bad. We don't like that. It's not like we could just go around and say, yeah, let's fix inflation by causing unemployment. We'd kind of have need some feel of cost benefit going on here. So what is that cost of lowering inflation? We call this the sacrifice ratio. The percentage points of annual output lost per 1 percentage point reduction in inflation. Typically, 5. What does this mean? In order to reduce the inflation rate by a percentage point, we have to sacrifice 5% of this year's output. That's expensive. Like, that's costly. This is not something we want to do. This is the reason why the folks at the Federal Reserve can be very worried inflation. Even if inflation goes from 2 to 3, like, this is fine, no big deal. But the worry is, well, if it goes from 2 to 3 this year, no big deal. But if it goes from 3 to 4, then 5 to 6, and 6 to 9, in order to fix that, we're going to have to incur a lot of pain. So we definitely worry about maintaining stable inflation rate, targeting somewhere around the 2% range. We can spread this cost over time. You don't have to sacrifice 5% of GDP in 1 year, but we can spread that over time. So in order to reduce inflation by 6%, we could sacrifice 30% of GDP for 1 year, which would be insane. Don't do that. We could sacrifice 10% of GDP spread over 3 years. It'd be a little better, a little less disruptive. Let's talk about disinflation in action. Remember Paul Volcker, the Fed chair in the 1980s? He was appointed in 79 for the purpose of getting rid of the high inflation. So he's like, yeah, we're going to install disinflationary policies. Between 1981 and 1984, fiscal policy was expansionary. Ronald Reagan passed his huge tax cut that pushes the aggregate demand curve to the right. So the Fed, to move the aggregate demand curve to the left, will have to cut money supply drastically, and he did so. He brought the interest rates up to double digits, like the base level interest rate, which means like just to get a car or a house, you're spending like 20-30% on an interest rate. That's insane, especially today when like a mortgage rate is 4%. 3.5%. A mortgage rate during this period would have been 25-30%, something really high. That is definitely going to cause a major recession, which it did. Because of the expansionary fiscal policy, the Federal Reserve had to be very contractionary in its money supply in order to reduce inflation. And they were successful. The inflation rate fell from 10% down to 4%, but it had a tremendous cost of unemployment. And here we can see what happened. So 79 to 82 to 81, we have the negative supply shock. Between 81 and 82, the inflation rate fell dramatically. However, we moved to the right from 81 to 82. We're over here now. The unemployment rate's at 10%, and we stayed there for 2 years. Between 81 and 83, we saw a tremendous drop in the inflation rate. You can think of moving from here to here as just a short-run Phillips curve. In order to do this, we must shift the aggregate demand curve to the left. We have to cause a recession. And then how did we go from 83 to 87? How did we go from 10% unemployment and continue to fall on the inflation rate? Is people's expectations changed. They saw that Paul Volcker and the Federal Reserve were committed and they believed them. And that belief influenced their expectations. They saw, okay, we're not going to have double-digit inflation anymore. We're going to have normal inflation. And by golly, this guy's going to do it tooth or nail because he's causing people to go unemployed to get there. So I believe him. It's a credible threat because it's happening. So moving from 83 to 87 would be a leftward shift in the short-run Phillips curve. Enter the next Fed chair, Alan Greenspan. 1986, oil prices fell 89 to 90, unemployment's falling. We had a little bit of inflation. The Fed raises the interest rate. There's a mild recession. We had the savings and loan crisis in 1990. During the 90s, which had a tremendous productivity boom, the unemployment and inflation fell. We had both things falling. Definitely had a leftward shift. We had a leftward shift in the Phillips curve, and that's where it's at. You want a leftward shift in the Phillips curve. Less inflation, less unemployment. The 90s were pretty good. In 2001, we had a recession. We had the dot-com bubble burst. Negative demand shocks create the first recession in a decade. Policymakers responded with expansionary monetary and fiscal policy. We had a little Keynesian stimulus under our Republican government of George W. Bush, and it was relatively small. And Alan Greenspan was in favor of it too. You can read in his book. I mean, he's like a super libertarian. He's like, yeah, we need a little bit of Keynesian stimulus, and they did. The recession in 2001, the dot-com bubble bursting, did not last very long. The effects of this recession were very small because both the Federal Reserve and the fiscal counterpart increased aggregate demand to make up for the shortage in spending from consumption and investment. And if we look at what was happening between unemployment and inflation rate, all the movements in the Phillips curve during this period, it's far more moderate than the big circles we were seeing in previous decades. So we have between 1990 and 92, unemployment grew. That was simply caused by a negative demand shock. So we move along the Phillips curve. Between 1992 and 1998, the Phillips curve shifted inward. Expectation of stable prices was starting to hold, and the natural rate of unemployment arguably fell a little during this period. Between 1998 and 2000, we were able to lower the unemployment rate a little bit. We increased inflation, so that's a slight movement along the Phillips curve again. And between 2000 and 2002, negative demand shock moving the other way. Positive movements along the Phillips curve to get to 2006, and then we're at the end of Chairman Greenspan's tenure. This tenure is noted by very stable prices, relatively low unemployment rate, not a lot of movement on our graph. Now the financial crisis. During the early 2000s, there was a housing market boom. It turned bust in 2006-2007. Household wealth fell dramatically in 2007-2008. Millions of mortgage defaults, lots of foreclosures, heavy losses at financial institutions. What happened? In our aggregate model, we had a dramatic shift in the aggregate demand curve. This means we're going to have a dramatic shift along the Phillips curve. Lower prices, higher unemployment rate. And we can see that moving from 2006 to 2009, the inflation rate fell dramatically, but then the unemployment rate also grew. Moving from 2010 during the recovery to 2015, we just moved the other way. The aggregate demand curve shifted back. Got massive government stimulus, and then slowly over time, the private economy started investing more, started consuming more. Positive shift in the aggregate demand curve, slow over this period, caused us to move back along the Phillips curve. What has happened since 2015? Not a lot. The inflation rate's been fairly flat, and the unemployment rate continues to decline and rests stable where it is now. There's a lot of discussion that between 2010 and 2019, the natural rate of unemployment probably fell as well due to a decrease in structural unemployment. There's less unemployment insurance, or less people on unemployment insurance. We'll end here by emphasizing that the Phillips curve is still active. People still use it. If you noticed all throughout those graphs, it didn't stay in one spot, and the slope wasn't always the same. It's not a perfect representation of reality, and some people are quite critical of the Phillips curve. They think it doesn't exist. However, if we incorporate the idea of expected inflation that would shift the Phillips curve around, it still has the capacity to explain a lot of the relationship between unemployment and the inflation rate. Today in 2019, there is a debate that perhaps the natural rate of unemployment could be even lower without causing inflation. This is an active debate. There's politicians both on the far left and the far right who are arguing for this. The Congresswoman Alexandria Ocasio-Cortez is arguing for an even more expansionary monetary policy, as well as the Trump administration agrees that yes, the monetary policy can be higher, and the Federal Reserve Chairman, Jay Powell, I want to word this carefully, he's not opposed to exploring these ideas either. Why are we not seeing higher inflation, given how much that we've pumped money into the economy in the past 10 years? First, during the recession, banks stopped lending loans, so the money supply stayed stable. The money supply was shrinking in the private sector, so the Fed had to increase it. Over the past 20 years, increased price pressure has been diminished by our increased globalization. More trade means cheaper goods, which in another word means lower prices. There might be some worry that if trade diminishes, there would be upward pressure on prices and the Fed won't be able to keep the unemployment rate as low and maintain prices. Finish with a graph. Here in the blue, we've got the employed population between 25 and 54 years old, so kind of the prime age. This is a ratio of population. So if this goes up, this means a higher percentage of the population is employed. So it's kind of the inverse of the unemployment rate. This is like the employed rate. And then in the green, we have average hourly earnings of production and non-supervisor employees in the private sector. So this is a measure of wages. And if we notice, the correlation between wages and employment is very, very, very close. So that's our section on the Phillips curve. I hope it helps you understand what the Federal Reserve is thinking when they do money supply, why they are quite hesitant for high inflation, and also why today, since we haven't had inflation for a long time, they're exploring a possibility of a relatively lower unemployment rate. That's this chapter, and thanks for everything. See you guys later. Bye.